question comes down to, is it the right time for you to buy? You know?
So is it the right time to buy, or is it the right time for you to buy? Right? You have to look at your life and your finances and where you are in life. Because if whether you're a growing family and you need something bigger, whether you're downsizing, whether you're moving. Sorry, I was like leaning more forward, right? Because I got away from the. Okay, I'm going to pull it this way. I told you I can't. I have to fidget. I'm sorry. I'm a fidgeter.
Pretend it's got a little leash on it, you know?
Yeah. So, no, but it's true, right? Because, people still need to move, buy and sell in every climate, right? But depending on whether or not your lease is up and the rates, not even the rates, the rental market. We were just discussing that, right?
Well, there's two different parts of it. One is a financial thing. The other one is a quality of life or a life situation type of thing. Like if you're in an apartment and you have people on both sides of you, you don't own that.
Right.
Just like you don't have a backyard for you to take your kids out to and barbecue or have a party.
Right.
So a lot of people focus on, the interest rate. They want to wait. Well, there's going to be a cost to waiting because what's the average appreciation? About 3 to 8%, depending on your area. So let's just say 4 is like a good median average.
I think we're a little higher, right, in this area, but generally, across the country, yeah.
So if you're going to wait, and let's say the rates drop 0.5%, maybe even you get lucky, they drop 1%. But now that house is now 4% more, there's a cost to wait.
Right.
And that's one of the things that I think people have the biggest trouble with, kind of getting them off their butt.
Pulling the trigger?
Yeah.
Well, I think that you have to look at that, what's the sense of urgency for them? Because, again, if they're waiting for the rates to come down, so is everyone else.
Yep.
Right. So then you're going to have multiple offers, which is going to drive the price higher. Right now, we're right in between. We're just about starting the spring market.
I think people are starting to see those multiple offers.
Right. Well, multiple offers, but there's still not a lot of inventory, right? So we still have a surplus of buyers, right? We have a plethora of buyers comparable to the inventory that's out there. But I think that if everybody's waiting to pull the trigger and waiting to see what the Fed does, if they drop it a little bit, you're right. Then you have multiple offers. You're ending up spending just the same or even more because now there are multiple people wanting that house.
Yeah. And one of the reasons I think that causes the whole seller shortage, I guess, or a shortage of houses. People have these low interest rates. I believe it's 65% of America is below 4% on their interest rate. So if they're sitting on a 3% rate, they don't want to sell yet because they're like, well, now I got to go and get a mortgage at 7% or whatever it is. So they're not putting their houses up. So that's part of what is contributing to the shortage. I believe there was also a lack of builders building a house for a period of time. Was it the 2010 to 2020? Maybe there was a shortage of builders, though, I think, of building houses.
Well, I think, too, not only building houses, but the seller doesn't have anywhere to go, right? So if the seller doesn't have somewhere to go, they're not willing to sell their house unless they have to.
Yes.
Like I said, there are still life events that happen. There's, you need to move up, you need to move down, death, divorce, I mean, you name it. It's unfortunate things, but people still need to buy and sell. But if just the normal market of people saying, hey, let's go out and take a look, they don't have anywhere to go. So they don't want to get into a situation where now they have to move out of their home where they didn't secure another home. And I think we talked earlier, the rent rates are much higher than what they used to be, right? So now you're paying someone else's mortgage, and you don't really know. There's uncertainty, right? If the sellers had the market to go to, right, or the inventory for them, they would be more motivated, right? It's the motivation.
Well, if you're going to sell, then it's like, all right, well, you can't sell and buy in the same town because you're going to get clobbered with your prices because you're not going to get what you're selling the price for because prices went up. So they're going to have to go south.
I think I disagree a little bit with that because I think it depends on how long they've been in their house, right? Because some of the more established neighborhoods, these homeowners have been there for 40 years, and now they're just looking to downsize to maybe adult community, but
downsizing
financially is a lateral move, like you're saying, like because they're but they paid maybe $35,000 for that house in the 70s, right? Or in the 70s, really. And now they're getting 450, 500, even 600, right? But now the adult communities, the new construction adult communities, and even some of the ones that are renovated are comparable in price.
They've jumped significantly too in the price of those houses.
Well, do you agree with me that it's relative though? Because again, if you paid $30,000 for your house in 1965, right? And now the kids are gone and you say, okay, I want to go to a ranch. I want to downsize, and you sell for 400 to buy. I don't think it's realistic for them to buy again at 100, right? Nothing that the standard, right? That's what I'm saying. It's not a realistic thought process. And even if you go south where?
When I say
because
south,
Florida
I mean,
is 50% up.
Yes.
Florida, you're not touching anything. I don't care where you are.
Jumped up. Texas is jumping up because a lot of people are heading there. So I agree with you on that. A lot of people they're not realistic with that. What I was saying was that if they bought the house for $45,000, right, and they're selling it for $5, even to find a ranch is still going to cost them $4 or more.
Right.
I was in a house the other day. It was a first-time home buyer house. It was $525 in brick. It was a 3-bedroom, 1.5 bath house, which to me is a first-time home buyer house.
Yep.
It's nothing special. $525,000.
Right. But I mean, look at your buyers, right? I look at my buyers, right? They're millennials. They're making the amount of money that they're making. They look and say, well, all right, I'm coming out of Hudson County where I'm paying $3,500 a month rent, right? I'm coming out of Hoboken, Jersey City, where I'm going to go now to the suburbs to get that house. So to them, they're used to paying that. So this mortgage is common for them.
Yeah, and well, now they're getting for that $3,500, which is roughly about what a $400,000 house could be.
Sure.
Depending on what they put down and depending on what the taxes are. But now they're getting a 3-bedroom, 1.5 bath house as opposed to a 2-bedroom apartment, or even a 1-bedroom apartment that's 750 square feet.
But we were talking, I think, earlier too about the first time, the entry level townhome buyers, right? Like the first time townhome buyers where that was $250. 300, even 350. Yeah. Now they're 450. If they're in Monmouth County, the tax structure is higher. The association fee.
I was about to say,
they don't get to write off.
The HOA fee.
Yeah, HOA fees. It takes them up and over, right? So that I think that most of the buyers nowadays shop by monthly payment, like they do with a car. Okay, I can spend $500. But they're not thinking. So the realtor in me says, okay, so if you're going to spend $3,500 a month, I'm going to go across all platforms and I'm going to look at single family home. I'm going to look at townhome with an HOA, right? And then give you options because I don't think they realize what they can get. And they don't realize that an HOA fee you can't write off, right? And that, I think we can agree that taxes really never go down, right? So you have to plan, right? As the appreciation of the homes go up, as your taxes are going to go up as well. So, you don't want to be house poor. You don't want to live to work.
And then to build on what you were saying is when you're looking at a house as opposed to a townhouse, then that also changes your price range because we were talking about payment.
Right.
So what happens is that HOA will affect the payment.
Absolutely.
So you get a little bit less on your house.
Right.
Than you would on if you were buying a house as opposed to a townhouse.
Right. But when the buyers are coming out of Hudson County where there's these new, luxury buildings, right?
They got a little spoiled with amenities.
They do, but it's a lifestyle, right? Yeah. It's the lifestyle. It's do they want to? Not everybody wants to. I don't want to say everybody wants to be a homeowner, but not everybody wants to be out mowing their grass on a Saturday or doing construction. Like some people just like the fact that it's newer. They don't have to worry about stuff like that, and some of these townhomes are larger than some of these first time. And not even I'm saying first time, but these 3-bedroom, 1.5 bath ranch homes, townhomes are larger.
Well, and that's one of the, when I'm doing a pre-approval with somebody and I'm trying to figure out what am I looking at? Am I sending them into a townhouse with an HOA or am I sending them into a house?
Right.
One of the questions I ask them is, are you okay with mowing your lawn and doing the things that you need to do on a house? Right. Because let's just face it, if somebody's single by themselves, they probably don't want to do all of that stuff.
Right.
So that's the other part of it too, is the lifestyle part. People
it is a lifestyle. I think we're going back now because of the age demographics of the buyers. Everybody, when you look at age demographics and how the baby boomers, the traditionalists, right? The millennials, they like that walkability lifestyle. They like Red Bank. They like downtown areas. They like where they don't have to get in their car. Most of them grew up in the suburbs and then moved to the city. I mean, I have a couple of them moved to the city, right? And now they say, okay, they miss that. Now they're back in the suburbs buying, but they can't walk to the store. Yeah, they can walk their dog, but the restaurants aren't close by. Everything is like you have to drive and go wherever you want to go, whether it's Asbury, whether, it's Long Branch, whether it's back up there.
There's also a difference, too, between Ocean County, which is, we live in Toms River here. My wife's from Bayonne, and we lived in Edison.
Right.
And South Edison was like the heart of Edison.
Sure.
Because you had everything near you.
Yeah.
Big difference between Edison and Toms River.
Sure.
And that's what a lot of people don't like. She's like, oh, this isn't that close. I was like, yeah, a lot of the restaurants close at like 10 o'clock, too.
Yeah.
So you see differences in
I happen to be a Monmouth County transplant to Ocean County, and you get a little spoiled, right, with Route 9 and all of the shopping there. And it's not to say you don't have it here; it's just the familiarity of what you have, and just a comfort level. I think for some people, but here. I think the further you go north, and if we're just going to talk construction-wise, the builders, Hudson County, Bergen County, the blocks are square. Right? Like here, just to make a left turn, you have to go an extra quarter mile to do a jug handle or a clover. I'm going to be honest, right? Like when you think about things like that, it's just different, right? It's just different. It's not bad. It's just different, and you get used to it. I mean, how long are you in Ocean County?
2.5 years.
Okay.
So
I'm about the same.
I'm from the suburbs because I'm from South Plainfield.
Okay.
My wife's from Bayonne, so it's a lot different from Bayonne to South Plainfield to Ocean County.
I did the same migration as your wife, Hudson County, then I went to Monmouth County, and then Ocean County. I love it. I think that it's more affordability here, and I think that for me as a realtor, that I think that's because of the commute times and where you work. But nowadays, most people either do half a week at home or they do remote 100%, so it doesn't really matter, but it's a lifestyle.
Yeah.
It's who your buyer is. And I think knowing who your buyer is, entry-level home buyers, they have a lot of student loan debt, right? That's coming into play on, what that looks like for them. Car payments where they didn't, if they lived in Hudson County or somewhere, had the walkability, a lot of them didn't even really have cars. Right, or they kept it in the garage in the building.
Do you know that the average car payment is now $750, roughly $760 a month, which they don't realize that affects their affordability or what we can give them on the mortgage side.
And what about student loans? How does that affect the affordability?
So student loans are a little different. So what happens is if they're in deferred, then we have to hit them with either a half or 1% of the balance as a payment.
Okay.
Or if they're in what we call an IBR, which is an income-based repayment plan, then whatever that payment is, as long as it's not zero, we use that payment.
Okay.
So it could be $25 and we use that.
I see a lot of refi going on with student loans for affordability. They come out and they have maybe 5 or 6 different loans. They keep their federal ones because they're very low, but if they have private ones, they're kind of consolidating them and buying them down and buying them shorter. I have seen that in probably the last couple years with some of the buyers that I've been out with.
One of the issues that I come across is they wind up having their loans in default because they weren't paying them. So that becomes a different issue, especially if they're federal. Then they have to get them fixed up and wait 9 months to be able to buy.
Really?
Yeah, with that.
That's a shame.
It is.
That's a shame. What else are you seeing?
Student loans, definitely a big one. For me, I usually see a couple of different things. People get scared. First-time home buyers, big time, scared. So some of the questions that I get, and you've probably gotten these before too, well, what happens if I can't pay my mortgage? Great question. So what happens if you don't pay your rent? After 30 days, you got the knock on the door and you got to get out. After 30 days, if you don't pay your mortgage, they just hit you with a late fee.
I don't get that question.
Yeah.
Because I think when I do a buyer consultation, I sit down and I'm very thorough, especially a first-time home buyer. And I say, you have to look at everything, right? Even though you're approved to spend $600, you might not want to spend 600. You might want to spend 500, right? And I send them to you before I show them anything, because if I start showing them 600s and then they make the decision to go to 450 or 5, nothing is going to be appealing, when you're comparing it to 6. But it's honest, right? It's an honest thing. Going to the
Mercedes dealer first and then realizing, like, hey, I have to get a Chevy.
No, well, yeah, it's a crude saying, but you can't champagne shop on a beer budget, right? And a lot of them have champagne budgets, but I say, okay, think about it. You're going to get married, and I have these frank conversations with them. You guys are getting married. Are you going to have children in a couple of years? Are you like, okay, so do you always want to work? Right? Think about what your life is going to look like 5 years from now. I know it's emotional. It's great right now, but let's think about who's going to, because childcare can bankrupt you, right?
Oh, yes.
I mean, I was fortunate I didn't have that, but I ask those questions because I think I'm just at a different point in my life where I see that, and I have children their age now, and I say, okay, what is it you want to do? Because they don't see
It's
this
very
is
hard
a generalization,
for them.
right? Like if we're talking millennials, they don't see 10 years from now. They don't think 10 years from now. They don't, right? And I think that we have an obligation to say, yes, like you say, this is your payment. If you don't pay it, they're going to come knocking on your door. But what do you want to do now? Maybe buy a little bit lower now or wait.
I agree with you 100%. Plus, buying a house is an emotional process for people.
Sure.
I'm the logical part of it, which people don't usually see or get. You're the emotional part of it because they fall in love with the house. They envision their kids being there, or they envision, moving in and cooking in the kitchen. And so it's very hard sometimes for people to back away and see that part of it, because I talk about payment too.
Sure.
Like, hey, listen, just because I can give you $600,000, you might not want to spend that. So let's think about that for a second. What about buying a house that maybe you can expand upon?
Right.
Because you can always renovate a house later or build an addition or something like that. Like you said, childcare, that's another thing that people don't think about.
Sure.
So they should be thinking about some of these things. But it's also a starter. It's a first house.
Sure.
And I equate it to this. I ask people, what do you drive? What kind of car do you drive?
Right.
Well, I drive an Acura. My first car was a Chevy Chevette. Big difference between what I'm driving then and what I'm driving now. So I kind of try to explain that to people to say, hey, this is your first house. It's not your last house. It doesn't need to have everything. It needs to be good, like you said, good for right now. That's what it is.
And I think if I could add to that, it goes when I had buyers, my daughter was one, in the last a year and a half, and two of my nieces, and it was like, is it a great time to buy? And I was like, or don't you think the prices are too high? If you're going to stay in your house for 10 years, it's never the wrong time to buy, because the market is cyclical. It's going to go up. It's going to come down. Rates are going to go up. Rates are going to come down, right? If you're staying there for 10 years, you're going to see it come back around.
If you want to laugh, somebody told me when I went to go buy my house, they said, you should wait until next year. The prices are going to go down. Now, we bought in 21. So we actually went under contract in March of 21.
Wow. So
Had I listened to them, that would have been very bad.
Right.
Because the way that I look at it is, I don't think prices are going to be going down for quite some time, because there's not enough houses out there on the market for people, and there's a lot of buyers out there that are still kind of sitting in the dark there, waiting for the right time.
But what do you think they're waiting for, though? What is the right time?
And I don't think they know what that is. I think they're waiting for rates to come down, or they're waiting
to tell them what that right time is.
They just don't want to listen.
Well, I don't know that they want to listen. I think that they're getting that 50,000-foot view of what the media is telling them, right? They're not talking to the local economists, right? Of okay, this is what this neighborhood is worth. This is what it was worth. We could go back and look from, prior to, the crash in 09, right? And you could look at where the prices were, right? In 08, your first one in 08.
Yeah. That was bad.
Why?
I closed in August of 08. September of 08, you couldn't get money.
Right.
That's when everything really kind of went downhill from there.
So do you think that your industry now is loosening up on lending? Because it was a little challenging in the last couple of years.
Yeah. So they went super tight
Right.
And then they started loosening up again a little bit. Now it tightened back up again a little bit because of the fear of what's going on in the market. Like a lot of people, like they look at the Fed rate and they think that affects us, and it actually doesn't.
Right.
We're not based off the Fed rate. We're actually based off of the 10-year Treasury. So, but a lot of other things affect us. The job reports, inflation, and things like that. So those are all factors right now. So certain areas they're loosening and certain areas they tightened. Like we had a no-income loan that was great. Right?
That was gone after the mid 2000s.
Well, they brought it back again.
Right.
And the last one I did was maybe about a year and a half ago. And because of everything that's been going on in the market, they kind of closed that back up again for a little bit. So now they're at like a 30% down payment where they're at 20%. So certain things loosened up and certain things like you can buy if you're not here legally now, you can buy with what we call an ITIN loan. So certain areas it's out there for people. You know,
yeah, I'm starting to see products too, like bridge loans or home-to-home loans, where they went away after 2009. But you know, people, that's also another reason why people don't want to, you know, buy now if they're selling, because most sellers won't accept a home sale contingency, right? So they're looking for cash, right? Or they're looking for that to make sure that the buyer that they do agree upon can get to the closing table. You know, sometimes the most challenging part is contract to close, right? And what that looks like. So I mean, I like that that's back. I don't know about like no doc loans or no income loans, but I mean, are they back? I mean, well, you said no income loans, right?
They're there for certain types of people. Like for people who are self-employed, it's usually very hard to buy.
Right.
So we actually have products that are bank statement programs or profit and loss based for people that are self-employed. So it's a little tougher for them.
Okay.
You know, even people like I'm a W-2. Your realtors are 1099.
Right.
So you're a self-employed person. I'm not, because I'm a W-2 commission salesperson.
Right.
But for people who are at 1099, it becomes very tough. Just like for the first-time home buyers, right? What they don't realize, do you know what the interest rate is on rent?
No.
It's 100%. And I'll tell you why.
Why?
Because zero of that goes to any benefit of the renter.
Sure.
So interest rates are 100%. So for all the people that are worried about the 7% or 7.5% interest rate, you shouldn't be, because it's tax deductible.
Right.
So really it drops it from 7.5 to say maybe 5.5, because you get back a portion of it, not all of it. Same thing with taxes.
Sure.
So people will say, "Oh, I'm paying $2,500 in rent, so I want to pay $2,500 in a mortgage." It doesn't really work that way, because now you have taxes and insurance to add on top of that. But the rent is 100%, and they don't. That's one thing they don't understand. You know, so it's like the one of the issues that we have in this country is that there's a lack of financial education for people too.
I agree. Yeah, I definitely would agree on that, because again, they're shopping by payment. They don't have a full understanding. And I joke and I say, you know, your payment is pity. You know, I'm going to pity you, but it's principal, interest, taxes, and insurance. But you say, oh, pity me. It's a joke, but they don't understand that. So it's up to us to explain.
It's got an I, not a Y.
Right.
But people don't.
Phonetics.
Yes, and I love that, because most people don't look at payment; they look at rate. And that's the wrong thing to look at.
Right.
You know, it's payment. What's my payment? Because that affects a lot of different things. Just like a lot of people, when they get pre-approved by somebody, they don't know if they're FHA or conventional. They don't know what their monthly payment is.
Well, I think sometimes even the realtors don't know, because now conventional has a 3% down conventional product that they didn't have before. And now, you know, the federal housing, they have, isn't there like a one-time rate reduction for first-time home buyers? Like you have an FHA one, but then isn't there one that's also unconventional? There's a
conventional has now a 3% down for first-time home buyers,
right?
Which is great, or even USDA, which a lot of people I don't think about. Like you can buy a house with zero down payment, and people don't understand that part of it. You know, you won't find it in Tom's River per se, but you'll find it south, and you'll find it like southwest.
Right.
So for anybody going down there, look at USDA. It's a great program.
Is it in Jackson also?
What's that?
Is it in Jackson?
It's designated by address. So a lot of people think that it has to be farmland, and it's actually not.
Right.
They do it based on population. So like South Brunswick has some USDA, but North Brunswick does not.
Right.
Because it tends to be more densely populated. But you can find it, like you start going down to like Little Egg or New Egypt and places like that, to absolutely you'll find zero down payment USDA properties. They don't have to be farms.
Right. Well, I think with the housing prices the way they are, the buyers don't have enough money to put 20% down, and they don't realize that they don't have to do FHA. And I think that's a misconception for them too. Like, well, if I don't put 20% down, I'm doing FHA, and then there's other fees, there's other costs. So, they have to really have.
A lot of people think like, oh, I need 20% down to buy a house, so let me go and let me save that up. But what they're missing is the math, right? So let's say you're renting, and let's say your rent is $2,000 a month, right?
Okay.
And let's say you can save up $10,000 in a year. You just spent $24,000 in rent. To try and save up $10,000.
Right.
You know how long it's going to take to save up 20%?
Right.
You're better off buying a house, paying the PMI, and at some point refinancing later, or FHA, or whatever it is that you're going to go.
Right.
You're better off putting less down and buying now than renting and trying to save up for later.
Right.
And that's a misconception that a lot of people have too. Oh, I'm going to save up more money. I got to put 20% down. No, you don't have to.
You don't.
Put your 3% down. Get your house.
Right.
Then you own something that's building equity.
Well, I think it's going to come down to affordability, right? And the payment, because they don't want to be house poor. They don't want to have to go get a second job. And they will, because they're young and they think, okay, maybe, or if they're downsizing just from your 5-bedroom down to, I don't want to say adult community, because they're either moving up or moving down, right? So when you're looking at that, it's like if you're going, it's relative. You're going from like, it's easy to go from 7 to 5, 700, sell at 700,000 and buy at 500,000, right? But to go from 500,000 to 7 or 750 or even 800 to get that bigger house, they're not first time home buyers, and it's scary for them because it's a lot. The taxes are probably double, depending.
Probably. My taxes went up $3,000 in the last 2.5 years.
Yeah.
So we were originally in like the $6,000 range, and forget about insurance too. I don't know if you've seen that.
I have, and that normally you could say to someone, or previously you could say to someone, okay, homeowners insurance is going to be about $1,100 to $1,300 a year. It's not anymore, because that's based upon credit and based upon all these other qualifications that they have.
A lot of the companies have been leaving New Jersey, so we've seen increases of 40% on homeowners insurance.
Really?
Yeah. So when I bought my house, I live in Silverton.
Okay.
Right? So I'm a half a block in from I'm not on the water. I'm not on a flood zone.
Are you talking? I was going to say. Are you talking flood insurance? No, just regular homeowners.
Just regular. I'm one of 4 houses that are not flood zone.
Okay.
So my insurance was originally $1,800 when I bought my house.
Right.
It's now $36,000.
Why?
And I just got a letter from them January 1st. They said you need to find a new company to insure you because we are no longer doing policies in New Jersey. So a lot of the companies have been leaving New Jersey.
Why? Why do you think?
There's the reason is they want to raise the rates, and the government's not letting them. But they also have these crazy reserves that they need them to have in order to be able to do insurance in New Jersey.
Got it.
So they're saying it's not worth it.
Okay.
Yeah. So it's interesting. I used to use $65 a month as homeowners insurance when I was doing pre-approvals.
Yeah.
A couple of years ago. Yeah. Now I'm at $150 for a single. If you're buying a multifamily, then it goes up from there. 2-family, I'm probably at like $250 a month, give or take. Anywhere to $350 if you're a 3 or 4 unit. Yeah. So that kind of factors into it too. It's like, oh, well, okay, well, now I got more money on this. But then what cracks me up is that people have all this credit card debt, but they want to put more money on the mortgage. And I'm like, pay your credit cards off.
Yeah.
You're 22% interest. Get rid of that stuff. It's
Right.
not tax deductible.
Well, yes. So I think back in 2009, when we had that challenging market, a lot of people had used their homes like an ATM from the late 90s, early 2000s, because the rates were so low. Refi.
No income loans,
Yeah.
ninja loans, Nina
Coffee
loans, all kinds of
you
other
name
stuff.
it. There was a loan for it, right? They would give it, desktop appraisals. Like it was just very loose, and it was.
I wasn't in the business then, but I knew they were saying, hey,
Well,
how
that was
much you want this
post
to be worth?
9/11, right? So they're keeping the economy going, right? And now same thing with the rates. COVID. Look at those rates, what they were. But I think the appreciation in the pricing, it's just not relative. Normally, for every 1% that the mortgage rate moves, the buyer or seller would lose 9% in a purchase price, right? Because if you're shopping by payment and you're financing, $450 at 5%, if it goes to 6%, that $450 is now only $400, and they just lost $50,000 in buying. I think that's the education that we have to give them to understand that it's not about the rate, right? It's about because the rates will always change and you could refi, right? You could do, what about products that allow buyers to do like a rate, just a buy down on their rate without having to do a refi? That's only FHA, right?
No, you can buy down a rate anytime.
No, I'm sorry, like if the rates came down, if you closed on your mortgage today, I thought there was an FHA product that said that if you closed on your house today and then the rates went down, you could have a one-time rate
with
adjustment.
FHA, what you could do is you can actually do what we call a streamlined refinance.
Okay.
So it's not a full refinance. So we don't need to do an appraisal on the property. We don't have to collect income documentation. So
There's no fee to it, nothing.
Usually the fee gets washed out by the lender.
Okay.
As long as there's an improvement or a benefit, we call it a net tangible benefit.
Right.
So as long as there's a benefit, then you can do that. So there's really
and that's only on an FHA product?
That's on FHA. Conventional has one, but they're FHA in some regards is easier than conventional is. But I know a lot of realtors don't really like FHA as much as conventional.
Well, I really?
Yeah.
Why do you think that is?
I think they get overly concerned with the appraisal.
Because it's more like a second home inspection?
Yeah. So they just look for a couple extra things, safety. I mean, they look for chipping paint or safety concerns, like if you have broken windows or things like that. But I think that it goes back to a lack of education.
Yeah.
There's a lack of education in that part of it to realtors. There's a lack of education to the buyers as to what they should be looking for.
Right.
Or what, like I always tell them, make a list. Make a list of what's important, like a needs list or like an absolute list.
Yeah.
Make a list of what you don't want, and then make a list of, if I could have this, what would it be? And this way you can kind of go through that, because your realtors are important. And I don't think that's another thing of perceived value, because they think, oh, if I go to a home buyer and just like a FSBO, that I can do that and cut them out. And it's a shame, because you provide a very valuable service. I've done a lot of transactions for FSBO type of transactions, and they're a mess.
You think so?
They can be.
Well, obviously, I agree with us providing value, because I've been doing it for 23 years. But you look at any industry, right? Even entertainment, the talent never negotiates for themselves. It's difficult if you're doing for sale by owner, if you're negotiating, because there's like you say, buyers buy an emotion, but sellers sell on logic, right? So the seller has that number that most of the sellers are logical. They have that number. I was going to
agree with that statement.
Right. So. But buyers, when they buy an emotion, because they do envision themselves there, the difference between $50,000 in a mortgage or $25,000 in a mortgage is not a big change in the payment, right? But for a seller to come down like $25,000, so it's hard when for realtors to give feedback, and you take the emotion out of it for the client, if that makes sense. But I think that it definitely comes down to an education on both sides. And no longer are we able to, as realtors, present our offer to the client directly. You're going through the other realtor, right? So it's not a love letter, but
no more letters.
No more. They're actually not. You can, but in practice we don't. Yeah. But I usually put why our offer is the way that it is. Right. Not so much a love letter about my client's personal information, but, the reason that this is our offer, because there's the theory of substitution, right? If you have two houses on a block for sale at $350, or let's get realistic, at $550 in this market, right? And the one comes up down the street at $500, he just sold because they're sitting out there at $550. So the theory of substitution is, well, why would I spend $550 when, even though this one has a brand new kitchen, I might not like the color, and I can do a kitchen, right, and do something like that. And I think that that's where we come in as realtors and that local economist, to say to the client, and even the seller, when the sellers say, it used to be, well, if my neighbor sold at $525, I'm coming out at $530, and then I'm coming out at $535, and it just kept going up, right? When we come into the spring market and we have 5 houses for sale, the trend will be down. Because you have to attract, even though there are a surplus of buyers, we have savvy buyers now. We have very intelligent, financially capable buyers that know what they're doing. And some of it comes from their profession, and some of it comes from their realtor, or wherever it's coming from. The seller, it has to plateau, and I thought that was me, sorry.
Well, what I was going to say, too, is that it's not always about the price. It also could be about the terms, too.
Sure.
Sometimes they need extra time.
Sure.
Like our seller, when we bought our house, They needed time
Yeah.
to move. And we were like, okay,
Yeah.
no problem. That worked for us. So we were cool.
Yeah.
And then they actually needed extra time. So luckily we weren't getting out. Like we weren't going to be on the street.
Right.
So we gave him the extra time and everyone was nice about it. We bought our house,
Right.
no competing offers.
Right.
They had an open house schedule. We said, all right, listen, cancel the open house.
Mm-hmm.
And our attorney got us out of attorney review very quickly.
Right.
And that's another thing that people don't understand is the value of a good attorney and getting out of attorney review.
Well, the value of using a real estate attorney, right? Because some people in their employment have legal assistance and legal. You need a real estate attorney, and you need a New Jersey real estate attorney because buying in New York is a different process than buying in New Jersey. And when you have buyers that are from New York, they get a binder until they have their mortgage secured, and then they do a home inspection, and then they renegotiate the price, and then once all the contingencies have been met, then they're under contract, right? Where in New Jersey, you are under contract, and then the only ways to get out of that contract is if there's structural damage or if you can't qualify for your mortgage. So I think educating your buyers into the processes, because, I mean, my whole career was built with clients on worst case scenario, right? Okay, so this is what happens here. Once we get, I feel like if you're informing your client and they're making fully informed decisions and they know what could happen next or what didn't happen, and okay, we're beyond that. Okay, now we go here. This is the next step or the next hurdle. I think that then they're much more confident. Because regardless of what their education is or what, even if they're not a first-time home buyer, maybe they haven't bought or sold a home in 20 years. It's a whole new process. It's a whole new process, right, of how you go through that.
I've had that before. They said, well, we've bought houses before. I said, yeah, but that was 20 years ago or 10 years ago. I said, I'll be honest with you, even if it was 2 years ago, I said, things change on such a quick level for us, both between what you do and what I do, because a lot of it's regulated by the government.
Sure.
So they come down with new changes and things that we can't do this anymore. We have to do it that way. Then another misconception for people is like, oh, you're just giving me your attorney because they're paying you for it.
Oh.
And they think that when a realtor recommends somebody that there's something there. And what they don't understand is that your team is important.
Without a doubt.
Because, when you have somebody that's online, try calling them at 7 o'clock and talk about an online lender. There's a couple of them out there.
Sure.
Try calling them
online
on Saturday at 12 o'clock to get an updated pre-approval or, hey, we have a problem, and people don't realize the value of communication.
Sure.
And education. Because education is super important. Like I had somebody that was using an attorney and they weren't a real estate specific attorney. They were a general practice. And it's like, would you go to your general practitioner to get heart surgery?
Right.
No. You go to a heart surgeon who's a specialist in what they do. Because a lot of times when you're dealing with somebody who's a litigation attorney, they're in court and they handle their real estate cases like litigation. I've had that happen before too.
Sure. He's
doing this. He's puffing his chest. And I said, we don't need to do all that. It's just a real estate transaction.
Well, I think it goes back to the relationship that you have, us as realtors, because I think we talk to the client more than the lenders do, more than the attorneys do. And, once emotion gets into that, it's sometimes hard to back out of. And that's why I feel like if you're informing them of what's coming next, even though you do it at the time of contract, as you're going along, there should be constant communication of, okay, don't be surprised if you have to, send your paperwork a couple times, for your mortgage in, because that lender doesn't do their underwriting in-house and it's going somewhere else, right? So it's very important who I do business with and who my affiliate members are, because you want to be able to feel confident when you refer them that they're going to treat your client the way you treat your client.
It's also too how somebody, when there is a problem, how you communicate that problem or that issue and explain it to somebody too. Like home inspectors, if they deliver an inspection report and they're like, oh my God, there's so many things wrong with this house. I wouldn't want to buy it if I was the buyer at that point. But if they deliver and say, listen, there's a couple of things that we need to address. The rest of the things are insignificant. It's how you deliver your information. Like if I have a problem, we need to fix this and then we'll keep moving. So a lot of times people don't deliver their information correctly too, and that's why it's important.
I think the biggest thing for attorney review, if they're first-time home buyers, they don't realize that the first line in an attorney review letter says, "I disapprove the contract as written." And, so if you don't explain that it's just a boilerplate that you're filling in, they'll call you up and say, "Oh my God, my attorney disapproved the contract." So you say, your attorney's going to disapprove it, but that's why we have all these letters and paragraphs, all the lines are numbered. You can follow exactly through what they're changing. Your attorney's going to change things to your benefit. Their attorney, this is just how we work. And I think it's about taking the time. This is someone's largest purchase, usually. Usually it's the largest purchase they're making in their life, whether it's 200 or $1 million or $5 million. You have to treat everyone the same way because they still feel the same way when they're selling that. They still deserve the same treatment. And I think that you have to explain things that are even outside of our normal, I have to explain a little bit about home inspections, a little bit about, about everything so that they feel confident when they do speak to them, because they're going to come back, they're going to ask me, they're going to come back and ask you. But I think that the rates right now are what's scary. What I hear from most of the buyers are, well, I'm going to wait because the rates are just too high.
So are the prices, and they're not going down. And it's funny what you just said because we all stay in our lane because we have to do that. I don't want to be an attorney or anybody else. But what you said,
have to know enough to be dangerous.
Right.
If that's for lack of a better term.
Well, that's what I said. Anytime that you have somebody who's a realtor or who's a lender, we need to know a little bit about what everybody does. So this way we kind of have an understanding about it.
No client wants to hear, well, that's not my field. Right. Talk to your lender. No. Right. And I think you have to bulletproof those transactions. You have to not wait until the mortgage commitment is due before you ask for it if you're representing the seller. You can have a good relationship, have them. Do they still have to give you permission to speak to their realtor?
No, we usually just do that anyway as part of the transaction. For me, when I have an offer that's going in, I normally actually call the listing agent, introduce myself, and give them a little bit of information. Hey, I just want to let you know I collect, because people they go online and they get pre-quals from an online lender that didn't even look at their documents. How do you know if they're even qualified?
Right.
And I'm sure that people see that all the time. When I hear a lot that realtors tell me that I never have a lender call me on a listing to talk about the person. And I think it's important to do that.
Sure.
Hey, you want to give confidence in setting an expectation. We send out weekly Tuesday updates to everybody. So that part of it, I tell the realtor, and they're oh,
in
wow.
their transaction? Everyone involved in the transaction?
Yeah, we send out two separate emails. We send one to the buying side and one to the selling side. This way, and we do it every Tuesday religiously. This way now, the realtor's oh, well, wait a minute. I'm going to have a lender that communicates with me on the other side. Those things are important. That's what I mean about the team and the communication. People don't realize how important effective communication is with people.
I just shortened it by saying bulletproof.
Yeah.
Bulletproof that transaction with
and
everyone
setting expectations too. If I tell you that every Tuesday you're going to get an email, an update, to me that's nice. Oh, I know what's coming. Otherwise, most people never talk about those kinds of things.
So are you finding with your buyers, are they buying rates that what's been the trend in your last 10 mortgages that you closed on? Did they buy rates down? Did they keep the rate as is? What do you feel they're doing?
Right now, I don't really advise people to buy down a rate. And the reason why is because what it's going to cost you, rates are going to come down, I think, in the next 2 years or so. So if that's the case, it may not be feasible for you to do. It may not make financial sense. Because what you have to do is you have to look at what's the cost and what's the benefit to me, right? So if it's going to cost me, I don't know, and for every 1%, you're going to buy it down by a quarter point, right?
Okay.
So let's say it's going to cost me, you're buying a $500,000 house, it's going to cost me $5,000. So let's say it saves me $30 a month, right? Well, if you're going to refinance in 2 years,
right,
$30 a month times 12 months,
right,
do the math. That's $400 and something dollars. So you're talking about $1,000, $2,000, as opposed to the $5,000.
Right.
So that wouldn't make sense. Now, seller buy downs can make a little bit more sense for people. The 2-1 buy down, I'm sure that you've probably heard about that.
No,
right?
tell me a little more about it.
Okay, great. So I thought you'd never ask. Oh. So the 2-1 buy down, what happens is it has to be paid by the seller.
Right.
And it goes into the seller's price, right? like a seller's concession.
Okay.
Because a lot of times people don't understand that it's part of your purchase
Well,
price.
it's a cost. Right.
So the seller will buy down the rate. So really what they're doing is they're actually prepaying interest for 2 years, right? So the first year is 2%.
Well, that's what we used to do back, 2007, 2009. Yeah.
These have been around for a long time.
They have
it's just they resurface.
Right. They're
Just like
called something else now.
203Ks have been around since the 80s.
Right.
And all of a sudden, a couple of years ago, everyone's talking about it because there was a lack of inventory or there was a lot of distressed inventory. So the buy down is a similar thing, right? So what happens is the seller pays it, and they prepay the 2% of interest for the first year and the 1% of interest for the second year.
Okay.
So it buys down, it makes the payment less.
Okay.
It doesn't mean the rate's changed because we're still qualifying them on whatever the rate is. So let's say the rate is 7.5.
Okay.
Right? They're qualifying on 7.5.
Okay.
Right? So the first year, it's going to appear that their rate would be 5.5 because their payment's less because the seller's paying that 2% of the interest. Now, let's say rates come down next year and they refinance. They actually get that money back.
So are you seeing a lot of that now?
Seen some. Seen a few. It's sellers are a little weary about it, just like sellers' concessions right now.
But it still comes across as a cost incurred to sell their home, correct?
Yes.
On the closing disclosure.
Correct.
Whether the buyer is putting on a concession or the seller's actually paying it, it's still a positive for the seller. I think if you're talking about is it a good time to buy, nowadays it's like it's a great time to be a seller too. Right.
It absolutely is a great time to be a seller. Not so much if you have to buy. If you're selling and then doing something else, it's great. But how are you finding sellers' concessions right now? I mean, are you finding that they're a little bit more?
The buyer is tacking on a seller concession? No, I don't really see too much of that anymore. I think that what we're seeing now is 20%, at least for me, 20% downs, right? I'm going on both sides of the spectrum. I don't really have a midpoint because I have some that are putting 25 and 20% down, and then I have some doing 3% FHA, taking advantage of the first-time home buyer program, the $15,000 that the state is giving them, and they just can't secure, 12 offers, and you're getting outbid on every one of them. I see a lot of buyer fatigue. There's a lot of buyer fatigue that are just checking out, saying, you know what, I'm just going to wait. And I don't know that they're waiting for the rates to come down. They're just tired of it's the emotion of, oh my God, this one's so nice, and then they see it the day it comes out. They write an offer, and then before you know it, there's 5 offers on the table, or they got it and they're in attorney review, and then someone came in and outbid them, right? And that just happens, and it's the nature of the game. But they're tired. They're tired of that.
It's like you have to train them for the Olympics because it's very tiring. I have people that were like 30 offers in, and they're like, I'm like, listen, if you don't stick and you don't keep going, you're not going to get a house. Right.
So for me, if they're in that price point of 400, where it's just there's just a saturation of buyers, right? I explain what we call the contract to acceptance ratio. And I say to them, don't be surprised if we have to write anywhere between 5 and 10 offers before we get one. So just know that that's a commonality. It's not you. It's not me. It's just what the market is. But we just got to stick in there. Again, it goes from day one, you setting that expectation, because buying is that emotional process and they're just tired.
I agree with you. Back to expectations, because if you prep them in the beginning, because most people they never think about that part of it. They never think about really like sitting them down and kind of going through the whole process of it and saying, listen, you're going to wind up getting tired.
Yeah.
You're going to wind up going against other people and you're going to lose.
Right.
That's just an inevitability of the way that it is.
But sometimes they'll attach that to the realtor or to the lender or whatever, right? So I think that when you set that up front and just say, when you look at the buying pool, we might have, 50 buyers for a 500 price point, but there's going to be 100 buyers for a 400 price point. So you just got to go in and be authentic. Don't overextend yourself. And you hate to say it wasn't meant to be, because no one wants to hear that. But when you manage that and set that expectation and manage it as you go through, they usually end up happy.
Yeah. It's like you said, setting expectations, or even making changes, like instead of going for the 500, like you said, or even instead of going for the 3-bedroom, well, why not go for the 2-bedroom, and then eventually you can make it bigger and
Right.
at least it gets you into the neighborhood that you
Right.
want to be. Or, it's a dated house and it's got Pepto-Bismol color and avocado color. See past that part of it because you can go and do.
Are there any of those left? I don't know. There's not many of those left.
A lot of the flippers have gobbled them up, but
yes.
there's still a few of them out there, that people held on to, and
Right.
maybe estate sales or
Right.
something like that. Like you said before, death, divorce, things like that.
Right.
Those cause, situations where people have to sell a home. But it's getting to see past that part of it.
So
for some
what do
people.
you think about the chatter that I'm hearing about, like the shadow inventory coming, where all of do the banks really have all of, these properties in their portfolio that they're, why are they not out now if the rates are so great? Like, what's the weight on that?
The rates are, and here's a common misconception, right? So people think that the rates are higher, that everyone's making a lot more money. That's not the case.
No. Yeah.
Yeah. And actually, we're making less money right now on the rates being this high because they
Why
don't
is
want
that?
to. Because they get scared and the bond market has moved. It used to be a direct correlation like you were talking about before, right? Where if rates were high, prices would go low, right? And then it would flip-flop where
Yep.
rates would go low and prices would go high.
Right.
Right? Now, that's out the window.
Right.
Right? Now, rates
they're
are high
both- and prices are high.
Right? So the way that we're based off of the 10-year treasury.
Okay.
We're not based off of the Fed rate.
Okay.
And it's a common misconception that people have. Fed rate directly affects variable interest rates.
Okay.
HELOCs, credit cards. It's the money that banks borrow from the government at an overnight rate.
Okay.
So when the Fed rate goes down, sometimes rates will go up. Right? So it's not a direct correlation that way for us. So right now, the Treasury bond is at an all-time high, so there's not money in it right now. And that's where the problem. Mortgage-backed securities, if you ever see
Right.
The Big Short, it explains
Yep.
a lot of it to you. So right now, there's not a lot of money in the bond, so that's why rates are high and people are paying points on top of that because there's no money in the loans.
Right.
Plus on top of that, between what you do and what I do, there's like 50% of the people getting out of business.
Sometimes that's a good thing.
It's a very good thing because we thin the herd.
Well, I think that you go back to being, when the market is challenging like it is now, you go back to being skills-based, right? There were a lot of people that got into our industry on all facets of our industry when, high tide rises all ships. You didn't need to, I hate to say, generalize and say you didn't have to have talent, right? But you would take a listing and there was a line at your open house on Sunday and your seller was like, okay, I have 15 offers. I don't want anybody else in my house. To now saying, okay, don't be surprised, Mr. and Mrs. Seller, if it's taking 30 days to sell your house, right? And that's you have to manage that expectation because you're talking about buyers. Talk to the flip side of the seller saying, well, my house didn't sell in a week, so what are you doing wrong?
Right.
Right. So you have to look at all of those. So you have to have skill. You have to know things about bulletproofing. You have to know about the cross industries that we cross lanes. I have to know a little bit about your lane. I don't want to articulate, too much about it, but I need to know enough because I have to articulate because I'm the one speaking to the client continually until they get an offer, and then you're, also coming into it then. But in the beginning, it's just the realtor.
Well, like you said, you're a good professional has a knowledge, a working knowledge, I think, of everything because they all kind of affect each other.
Sure.
Like a little bit about mortgages. Like a lot of times people think like, oh, I can't get approved. Well, how do you know?
Right.
How do you truly know if you can get approved or not? And I think one of the biggest things that are holding people back from buying their house is fear.
Fear of the unknown?
Fear of everything, right? In one way, shape, or form. Fear that my credit stinks and I can't get approved for a mortgage, or fear that I don't have enough money to be able to put down on a house, or fear of of what happens if I can't pay my mortgage, or fear of a lot of different things, or you just fear in general. A lot of people are doing that, or afraid and thinking about like FOMO. Oh, what happens if the rates go down and I bought now and I should have waited? Kind of those things I think are holding people back. There are houses out there, not as many as there should be.
There are. I mean, inventory is actually on the rise. I think that if I can grab my paper over here. I study the numbers on the MLS, and Monmouth County for single family homes, the inventory is down a little bit. Last month was 746. This month it's only in the 690 range. But in Ocean County, last month was 775, and this month there's 813 homes actively for sale. So the inventory is picking up a little bit, but everyone still thinks there's such a shortage of inventory. We're 98 on condos, 87 were last month, there's 98 this month. In Monmouth County, there were 197 condos last month, there's 202 now. So, you're going to get, the inventory is going to come up, but if you wait until there's a lot of inventory, there's going to be a lot of buyers.
Yes.
Right? So then there's more competition. I think that there's a seasonality to our industry, and everybody kind of looks in the spring and thinking, especially if they have children in school systems, maybe they're going to move over the summer. It's a easier move in the lifestyle instead of pulling your children out of school, mid-year. I think that in my experience, in my 20 years, the buyers in the fall, I might have less buyers, but they usually all buy. They don't mind moving their children through the winter break or whatever, because there's a need, right? We talked about there is a need, but if the need is there, they're going to find what they're looking for. If you have people are just waiting to take advantage, I think that's where they're going to go wrong, because then once you have 10 homes for sale, you're now going to have 50 buyers. Right now you have maybe 2 homes for sale and 10 buyers. You have a better ratio to get your offer accepted.
Well, that's why I tell anybody that I deal with too the same thing. They say, "Oh, should I wait until spring?" I said, "Well, you're also going to be dealing with a lot more competition in spring." I said, "So really the time to buy is whenever you're ready."
Right.
If your lease isn't up until December and you can't get out of it, then you're probably best not looking right now to buy a house, because you can't even buy it if you wanted to, because you're still in your lease.
Right.
And they might hit you with a 6-month penalty to get out of it. So it's important to find out, like, if you are going to do that, find out, like, when is your lease up? Because a lot of times people think about waiting towards the end of their lease, and they really might want to start looking around the 4-month mark.
Right.
Because you got to find out.
That's usually what I say, because, I don't think you can if you need to, but we really don't do 30-day closes anymore. I like to do 45. If you could do 60. We have a lot of sellers that are looking for leasebacks, right? Because they're not sure where they're going to go. So if you do have a buyer that says, "Hey, listen, you could stay," right? You talked about that, right? It's price, time, and convenience. So if they're giving you your price, you have to give them their convenience. If they're giving you your convenience, you have to give them their price. Right? If you want to stay there until your kids are out of school, like right now we're in February, if you want to stay in that house until June, it's still a good time to put it on the market and see. You'll get a buyer that will let you either wait till closing or lease back. Because I want to say most of them are lease backs because of the rate, the fluctuation in the rates. The buyers want to close on the rate and lock in, and then they're okay with you, paying that.
Well, yeah, and a lot of people don't realize that. Like, we can close a home in 14 to 21 days.
You can, yeah.
But is the seller, and it was a great point that you made, is that good for the seller? Because a lot of times they're not going to start actively looking until they wind up getting an offer on their house. Am I correct?
Depends on their situation.
Right.
But yes, I think that for me, the biggest challenge that I have with the sellers is they don't expect, and I make it very clear, are you prepared to sell your home this weekend? Because some sellers who have been in their home 20 years plus, they still think it takes about a month. So you put it out there, and then all of a sudden they have these offers, and like, wait a minute, like they didn't even take a breath yet, right? It's true though, right? So I say, are you prepared? It doesn't mean we're closing right away. So let's think about that. I have one right now. He's retiring, so it's April. So we say to the buyer, are you willing to do this? And they're waiting.
It's convenience, the seller has to go out and find a house now, and then they have to do what they're going to do. Hopefully they have a good mortgage person on their side. We just dealt with that too.
That's a fair point though too, because a current seller that I have, he had 2 offers, apples and apples, right? So he went to look, he's in finance, who are the lenders, right? And he went with one that has a lender that he's comfortable with, right? Because he was not comfortable with just an online pre-approval. Not that there's anything wrong with an online company. He just, in his mindset, and that goes to the different generations, he was more comfortable with the lender on the second offer. So he went with that one.
It goes to terms. It's not always. Sometimes I've had people that won an offer because they had better terms than the higher price. And some of those things do matter for people. So it's good for them to kind of.
Well, I think that goes back to a seller being more confident that even though they're getting all their money at closing, they might, even though the price is the same, they're going to go to the term that's putting maybe 25% down, as opposed to someone doing FHA. So even though you're saying most people don't want FHA, I think that the sellers feel more confident when they see more money up front, and it's our job to manage that expectation, to say at the end of the day you're getting all your money at closing, so it doesn't.
So what difference does it make if they're putting down 5%
It's
or
perception
20%?
in the seller. It really makes no difference at the end of the day, because the buyer is the one that comes to the closing with the bucket of money. Right? The seller is getting their money at the closing table. I think that when they see a lesser amount coming down, it's how that offer is presented, because someone can be a stronger buyer with less money down because their terms are better. They don't have a lease. They can extend other things. Right? So